Welcome everybody. Hope you guys are good. Brent, people just jump in usually as it goes, so um, no worries. We're recording this and usually put these out. So my guest needs no introduction, although I'll give him one. This is Brent Kochuba from Spotgamma. If you have been in the option space for any length of time, you have heard Spotgamma, heard of them, and you have probably used them. I remember very early on, I think if you guys watched in 2018, right?
No, actually a little bit later, January 2020. So like, it was like right when Trump said that we're shutting down for 2 weeks. That was like the first week I started publishing stuff.
Oh wow. Okay, man, that was early. Yeah. So I remember very early, just knowing Greeks, knowing options, but never had really conceptualized the idea of cumulative gamma in the market, cumulative delta, and things like that. And you guys came along and kind of put out some metrics that I found really, really fascinating. And so today, what I thought to do, having for a couple minutes, is you've probably done this 1,000 times, but I'd like to kind of maybe start with some beginning stuff, just where you're from, who you are, and then why you thought this was a valuable idea and things like that. So first off, welcome, Brent Kochuba. You're the man. So thanks for being here.
Thank you, Troy. Yeah, so the way that it worked for me, I spent about 20 years on, or have about 20 years of experience, I should say. It's sell side primarily, and then buy side kind of towards the end. I was a broker in options and in equities. And then towards like 2015, I left to go to a family office, and literally so the family office was trying to start a vol fund with a well-known volatility trader who worked for Millennium at the time. And so I was basically going to be like kind of like the jack of all trades for that guy. So like I would learn from him as a PM, and I would do the trading, and then I had to do systems work, all that kind of stuff, whatever. The first week, so I had to take like a 30 days off, from being a broker to make sure, like for compliance purposes, right? Once you quit a job at trading one spot, they make you usually take some time off. So I had to take 30 days off. My first week back is August of 2015. We traded for a week, and then, if you may not remember this, but I think it was August, date is escaping me now, mid-August of 2015 was at the time one of the market went limit down on Monday, and it was like one of the biggest volatility spikes that we've ever had. And so that was like my first week of experience kind of like on the buy side, and that didn't work out very well for that PM and that strategy. But I learned a lot about margin calls and things like that, and being on the wrong side of options and convexity and things like that. So fast forward from that a little bit, I just spent all my time basically like programming models, like building in models that looked at the S&P options complex. And through that, I saw, by monitoring every single day, how the market moved around these big options levels, how implied volatility mattered, or why implied volatility mattered. And at that time, and kind of like heading into 2020, like options were a big in the S&P 500. They were very actively traded, in single stocks, but it was not like today, right? Like, obviously options volumes just blown up starting really in kind of 2019. But that's really how I started to see, okay, look, the options market matters. And so I had built all these models, and then when the pandemic hit, the family office I worked for, where they were primarily in real estate, they shut down anything that wasn't like essential. And so I had, written all these models, and, had done all this rather in-depth analysis of the options market, and I was putting some strategies together. Then you suddenly couldn't leave your house. So I started publishing the notes online, and people started paying for them, and knock on wood, that picked up really fast. I did a forget the name of the Market Huddle. Sorry. I did Market Huddle podcast in January of 2020. And that was where I laid out the idea of gamma. What is gamma? Why does gamma matter? Why does, how does options hedging affect the market? Right. I laid out all these ideas, and that really that was the kind of like coming out party for Spotgamma. At the time, no one else was really doing that research. You could really only get that research. Zero Hedge would post notes from Charlie McGilligan every once in a while. And so I thought, well, all these people are really interested in this data and this kind of information. You literally couldn't find it anywhere else. So why don't I'd done a lot of writing from an institutional kind of lens, or in that tone, so to speak. And so, so that's really how it started. And, now there's so many gamma providers out there and things like that. But, at the time, this was a really novel idea, right? And it was different. And in January of 2020, it was about trying to convince people that the options market could control the stock market. Like, people just didn't want to believe that concept, right? It was hard to get people on board. So I spent most of my time here's where the options are. Here's where there's big gamma levels. Here's how, this is affecting the market. I can predict some of this stuff. Look what happens after options expiration, all these different things. In March of 2020 hit, and a lot of people started to subscribe to this idea that, oh, look at all the puts that were in March of 2020, and look how crazy it is that we bounced the third Friday after in March, right, of 2020. The low was the day after March options expiration, right? What a coincidence. And you could start to see some of these things form. And then obviously January 2020, all hell breaks loose with meme mania. And then after that, it became like, okay, we all understand now that the options market can move stocks. And now narratives have changed a little bit too. So it's like, let's try to predict where this stuff can happen. And what the bottom line is there are these hedging flows that are tied to options trading, and can we predict how that's going to impact the market? And what I believe is so unique about this kind of analysis, we call it positional analysis. That's kind of a term we've coined, is that you have technical analysis, which is obviously we all know Fibonacci's and support and resistance and yada, yada, yada. And then there's fundamental analysis. And what positional analysis is doing is looking at obviously how these options are positioned and trying to predict how a counterparty or counterparties are going to take action. So, we're in a short game environment, long game environment, whatever, or there's going to be a margin squeeze here, right? Or there's margin calls in this name, or this has a ton of borrow interest, right? And people are going to get squeezed out of it. So that area of positional analysis, I would say, is not just really just the options, even though that's what I really look at, but there's these other concepts, right? Of predicting what other people's behavior is going to be, I think is to me the most interesting area of the market. Because I know when options expiration is going to come, right? It's going to remove positions, right? I know through open interest analysis where people are positioned. I have to figure out who those people are and what actions they may take. Are they a dynamic hedger, or are they not a dynamic hedger? Or is this retail exposure, or is it something else, right? But I do have, and I think we have an edge here when we look at the options market in this idea that we have this open interest. And we know when that open interest is going to change. We can see how people add or remove their position every day. And to me, that gives people a real edge. And not only that, the more volume that takes place, the more of an edge arguably we have here, because the positions are larger. And then you have implied volatility and some other metrics that you can kind of pull in and combine with this to help you to even expand on that analysis. So that's what I think is so interesting about the options market, and why I think that again there is this extra bit of edge in this type of analysis over some technical analysis or maybe in fundamental analysis to some perspectives. I'm sorry, Troy, go ahead.
No. Please finish.
So I was going to say, so on a daily basis, we're looking at how these options hedging flows are changing. And how that's going to impact the market. And generally on a 30-day maximum basis, that's changing a lot because of zero DTE options. And because the market's been so negative, right, and volatility's been higher, but put positions have come down. I think that the way that we used to really look at the market and a lot of the sort of the truths that you would have or things you'd really believe into 2022 changed. And now we're in this really interesting environment with the bank crisis where zero DT has picked up and people have not wanted to tail hedge, but now there's maybe some tail hedging going on. And so, there's a lot more changing, I think, in this market environment than specifically in 2023 than I think we saw in 2022, or before that, right? Just based on the kind of positions that we see in the market and who the players are. And at the end of the day, it's all about trying to figure out, how are people going to hedge and when are they going to hedge and how is that going to affect the market? I can continue with my diatribe. I can talk endlessly about anything here.
No, I love it. Well, I want to get into some of the things you just said are really interesting to me. Uh, for those of you who are not subscribed, I'm not going to save this to the end. I'm just going to say it now. For those of you not subscribed to Spotgamma, you should just subscribe to Spotgamma, because one of the things they put out is a morning and an evening note. And Brent, I can't imagine you write all of those every day at this point, but I know you wrote a lot of them.
Yeah, I write all the AM notes. I write, and then we have somebody that writes the PM recaps. So I've written every AM note. I think I'm on. I've only ever missed one, and that was New Year's Eve of 2020, or New Year's Eve day or whatever.
Troy, are you there? Can you hear?
Yeah, can you hear? Yeah, can you hear me?
Yeah.
Sorry about
You're back.
that. If I lost again, Rusty and Matt are on here, so sorry about that, guys. Yeah, I was just gonna say subscribe to Spotgamma if you heard that part. I'll text it over and over again. But they've got good stuff going on there. One of the things I wanted to talk to you about was last year, like you were saying, the model has changed.
Mm.
And the interesting thing about Spotgamma is you have these metrics that happen through time. And the thing that I have found personally the most interesting through time is the idea of the vol trigger.
Yeah.
Can you speak to a little bit about that, of like as a general metric, what you're looking for in that, and what that might show about what environment the market's in on a day-to-day basis?
Yeah, it's a great question. So there's a few ways to think about that vol trigger. I think from sort of inception, really up into 2022, that was our metric of gamma flipping, and into 2022, I think what that really meant was you have like a pretty low volatility environment above this volatility trigger level, and then a higher volatility environment below. And kind of like how people would use maybe a moving average, like a 50-day moving average, as like this level where it's like, I'm going to own the stock until we break the 50-day or whatever, and then the market could really crash below the 50-day. Well, the vol trigger is kind of a similar idea. And there's other people have this idea of zero gamma. And what's different about this vol trigger level is like we basically pretend that the options market, right? Every options position is part of our portfolio, and we analyze how we would hedge this portfolio of every single open interest contract that has open interest. And so this vol trigger for us is this level at which should be like the last bit of hedging flows in whatever regime we may be in. So regimes being either a positive gamma regime or negative gamma regime. And so the idea is that at that level should be some, last gasp effort of support or resistance. And then if we break through that level, then this regime trains. And typically what happened is the market would go up and up and up and up, like in 2020 and 2021. And then, we would break this level. And that level is this area where below the vol trigger, we have predominantly put positions. And so you could also think of the vol trigger as this area, almost like a max pain area or as a level of measuring, where are the bulk of call positions versus put positions, and where do we transfer between those two? Because if you think about what the difference is, well, with call positions, we have, again, lower volatility environments. People are more comfortable holding calls, I think, when they go in the money. People like to sell calls, right? That's typically your long stock and selling calls against that. So volatility in general tends to be lower when you have, I'm speaking about the index, of course, high call positions. There's a lot more stability in those types of markets. Compare that to so below the vol trigger, we pick up mostly put positions. Put positions come with high volatility, these negative gamma regimes where we're buying puts because the market's crashing or worried about the market's crashing, right? There's a lot more anxiety in those markets. The trading ranges are much wider, and there's just in general a lot more movement. And so, we by default view the market as in a bullish position when we're above this volatility trigger, because we see that there's predominantly calls in the market. We think there should be less overall volatility, which if you look at common or sort of modern portfolio theory, lower volatility is generally associated with higher returns over time. I think the holy grail is to get like 10% returns every year, right, with no volatility. I mean, everyone would sign up for that. And then obviously below that volatility trigger, you have again, put heavy positions, high volatility, et cetera. Now, the issue with just using that as a trading strategy is that depending on exactly the time frame you look at, it will underperform the market because you don't historically, it's not a good bottoming indicator, right? So like if we break the vol trigger, just like if you break a 50-day moving average and you crash, well, what is the point at which you want to get back in, right? And buy the dip. Like the dip buying is a huge part of turning that vol trigger into a successful trading strategy. And so you can look at other tools, right? Like when are big options expirations, right? How's implied volatility shifting, et cetera. But if you just sort of use that volatility trigger, and for a long time I've thought that, hey, if I was like a long only portfolio manager, if I had all my money in a 401k or something, if every time we got near the vol trigger, we would just buy a put, right? Maybe 1 month out, 10% of the money put, whatever it may be. What would those portfolio returns look like? And I think that's actually something that you guys, can do. And I think we're talking to you guys about maybe running some tests like that. But that's what the idea of the volatility trigger is under this level, volatility should spike, the regime should shift, and how you trade, I think, should shift, right? You want to be a little less systematic about maybe how you trade. Like, I don't want to just sell a straddle every day if we break the vol trigger because things move a lot more, right? Do I want to have more of a long game of positioning to what I'm doing, that kind of thing?
Yeah. So that is interesting, and yeah, we are working on some of that stuff with Spotgamma. And one of the very interesting things that I found is the vol trigger. It's right. Yeah, it's not necessarily like a binary like switch, like do this if it does that. But what's interesting is through time, the vol trigger, and you could speak obviously more to this than I can, but my reading of it is that the vol trigger is never far from the market. Like it's never that far from spot on a day-to-day basis. And one of the interesting things you get therefore with that is you have these other concepts of a put wall and a call wall that kind of
rein the market.
They kind of rein in the market, and those are shifting as well. And so it opens up these possibilities, especially when the options market is, most of the people, option Omega traders, are not long only or short only traders. We're just trading. We're either long Vega, long Theta, things like that. And so one of the things that's interesting I found through that is that the put wall and the call wall being kind of these, they're reigning in the market. You have this interesting play at work with those three indicators through time, because the call wall, like, correct me if I'm wrong, like last year, some of the things with the model shifting in this kind of environment was like, at times, like the call wall and the put wall will be wider, right? Depending on where the volatility is in the market and things like that. But I found that very interesting, that the vol trigger is more or less always within a standard deviation move of the market. It's never out of reach. So those three metrics I know from the beginning you guys have, but you've developed more things. And one of the things that's super interesting that I know a lot of people use is Hero. And can you speak a little bit to the Hero indicator?
Yeah. First, what I'd say in regards to the way that the levels move, I mean, I think there's information in that, right? How are those walls shifting day to day? Tell us how people are changing positions. And when you know how people are changing positions, then you can obviously, draw some conclusions from that, or some inferences, take some inferences from that. And I think it helps to inform trading strategies. We've also found, we've done a bunch of stats work on this recently, and we found that, when you're in sort of what I was talking about before, when you're trading up around this call wall where there's big call positions, the volatility of the market, this is statistically backed, this statement is reduces sharply. And so when you look at the forward, 1 to 5 day, returns of the market, it's like 25 basis points, and it tends to be slightly negative when we're at this call wall. So basically the market goes up into that level and it pins. And conversely, when you look at the put wall where we have giant put positions, the forward returns are actually positive when we break that level. And I think that's largely because people are closing puts and rolling them, and that reduces dealers' sort of short exposure, so they can cover. But the distribution of returns is really way wider around there. And so again, you want to be careful of being like short Vega at this put wall level, whereas at the call wall, you want to be short Vega. Of course, the prices available don't make it so easy. Typically,
right.
Implied vol's getting crushed at that call wall level, and so can you extract actually extract some premium from there? Can be a little tricky, but part of what has changed so much about the market on this idea of hero is the amount of zero DTE trading. And we started talking about this in October of last year and into February of this year, for whatever reason, everyone started to pay attention to it. And not in the options industry, just kind of like the finance world writ large. And about 40 to 45% roughly in the S&P 500 now of volume is zero DTE. Again, this is for the S&P 500. And that's been stable. So that immediately when we launched zero DTE into November, the volume went to 45% roughly, and it's pinned, right? So we haven't had the situation where now we're doing like 60% of zero DTE. The highest level we've monitored is 53%. And so what Hero does is it monitors every single trade that comes into the market in real time. So we look at what we think the hedging impact of that's going to be, and then we have a couple of different filters or lenses. So one is we look at every single trade that comes in, and we try to portray or estimate how much hedging flow is going to come in. So are calls being bought or sold, or puts being bought or sold, and then how many dealers hedge that. So if you look at what's been happening over the last few days, every time the market rallies up into the 4,000 level, the S&P 500, we see what's called negative delta flow come in, and this Hero tool is showing us this. So basically what happens is every time the market rallies up into 4,000, people are buying puts and selling calls, and they've been doing it like that every day for like a week now. And so when you start to see these patterns, right, in this Hero tool, and you start to see like, oh, we already know through like the morning notes, right, that there's these big gamma levels at 4,000 and above. I think you start to put these pieces together and get a real great idea of what the market exposure is in terms of the options market's exposure there, and how can I trade against that, right? And how do I want to position? And if we sell off from 4,000, what is that about, right? If you read like CNBC or something, they'll try to make up a reason for why the market is down, and oftentimes it's just hedging flows, or there's big options trades or whatever it may be, right? It has nothing to do with some random headline, right? And so with that Hero flow, again, is showing you in real time. If you're an active trader, I think it really gives you a lot of information, not just in the S&P, but also in single stocks. So one of the other lenses we have is a retail filter. We show you just what retail traders are doing. So you can really, again, put together the piece of how much hedging exposure is being added, where are the big pockets of gamma, or what strikes should I pay attention to, how is options flow changing at those strikes, right? We'll often see like, here's where all the gamma is in Tesla, and then when we get into that level, the flow will change, the options flow will change. And we are currently, and we've built in some alerts, real-time alerts for this. So we've identified, statistically speaking, we had an independent guy come in, do a bunch of analysis on the data we've accrued so far, and we found some alert mechanisms. We're going to be launching those pretty soon. But basically, we're reading the options flow and we can say, okay, this is a moment where the options flow is driving the stock. You want to sit up and pay attention, right, if you're an active trader.
Yeah.
And just, I'm sorry, go ahead.
No, please keep going.
I was just going to say, so we have this tool that reads the options market in real time, and I've done a lot of work on zero DTE, and I just sort of, my takeaway from zero DTE is this: it is suppressing volatility intraday because traders are buying these short-term options. If you look at it, and you can see it in Hero every day, this has been written now in Morgan Stanley, Bank of America, and Goldman have all said that zero DTE buyers, so that corroborates our longer-term data. Well, on the open, we'll see is people are buying puts and they're buying calls, and then they monetize those positions, opportunistically. So if the market moved a lot, then they'll monetize intraday, or you'll see into the close every day through our Hero tool. You'll see that flow change. So like, let's say that we're all long calls, and the end, we all bought calls in the open, right? And into the end of the day, the market's rallying real sharply. Well, we're going to close our zero DTE calls out right when we get a chance. Particularly true in the spiders where we don't want to get assigned 100 shares of spider at the close, right? SPX cash settled. I'm fine letting the cash maybe settle on my account, but spiders, typically you'll see that flow kind of unwind. And so this is particularly true after big drawdowns. So if the market overnight moves down, let's say 1%, you'll see much stronger zero DT call buying. And I think what that is a lot of gamma hedging. So if you own, and this is a theory that I have in terms of like why people are doing this, but if you own, let's say, a bunch of April puts, particularly if you have a lot of them, you can't just close those, right? Maybe they're a structural hedge for your portfolio if you're an institutional investor or whatever. One of the nice ways to rather than buying some stock or sort of dynamically hedging, if the market's down a lot, well, why don't I just buy some 0DTE calls? I have a fixed cost there. I can just roll that out, and if the market rallies, great. I got a nice little cheap hedge on, and I can monetize or I can gamma hedge myself effectively that way. And if the stock goes down, continues to go down, I still have these puts on, and I didn't get dinged too badly because those 0DTE puts are pretty cheap. So that ability to hedge, I think, is quite helpful. But at the end of the day, I think because you're getting long buyers of 0DTE options, it suppresses volatility because of these exact reasons, right? The market gaps down overnight and everyone comes in and buys 0DTE calls. Well, that should invoke hedging flows that pushes the market back up, right?
Yep.
And so that's an example. So when you look at it on like a close-to-close basis, well, maybe the market didn't move versus yesterday, even though we had a huge intraday dip at the cash open. And you see that market move back up. So we see, this is something I've seen in the data. We're trying to put the finishing touches on our presentation here. We're going to do a pretty in-depth presentation on this stuff. But that's really what the takeaway is. And now that you guys kind of know that, if you start to watch the fingerprints of this stuff, again, if you look at Hero, everyone can get a free 7-day trial of Hero. Try it out. Even if you don't have any interest in keeping the product, try it. It's free for 7 days. You can see these flows come in, and you can see what I'm talking about. That's
interesting, and this will kind of be the final question because I know we had a short time with you today. But I've heard it said by various people that the 0-day traders are these. I think there was a false kind of narrative when 0-day first happened that it coalesced with these large movements in the market, and so I think a lot of kind of CNBC media type said, well, this 0-day stuff these are just GameStop traders who are just YOLOing all day long. And I think what you're speaking to is kind of, my opinion, but I think it's the truth of it, is that it's doing a lot of different things. It's actually a ton of hedging flows, but it's actually, yes, the moves are larger on an intraday basis than perhaps 2 years ago, right? I mean, there are wild swings in the market, and 0-day is causing that, but 0-day is also causing the cap on a mass movement of the day. So you're not getting these 3-4% days that happen throughout history, perhaps because of 0-day, but you're also getting larger intraday movements because of 0-day.
Yeah.
Is that the read on it? Am I
yeah,
right
and this again speaks to specifically the index stuff. I think single stock, you got to look at it slightly differently. I mean, I think those GameStop kind of YOLO guys are still active. You just look at like Nvidia and AMD like kind of last week. So in the S&P 500, I agree with you. Like you get much more 1% swings, but if you think about what's happening, they buy 0DT calls on the open, the market rips, they sell them, or they buy puts, and then so it's this washing machine effect that creates like big sine wave, I guess, of intraday movement. But yeah, to your point, I think why don't you sort of see these bigger directional moves? And I think now that part of it is we got like 6 months of real data now on 0DT. I mean, they just started fairly recently, and we haven't had a huge drawdown. But the liquidity, in this market is pretty poor. I think if you just look at, there's a lot of random charts that pop around about ES futures liquidity and things like that. So there is a lot of volatility in the market, and I think you have this other compounding effect of record 0DT volume and record options volume just in general, which should invoke more hedging flows. And those hedging flows are occurring at a time when liquidity in the market by almost all measures is pretty poor, right? So that should just magnify the effect of all of this stuff. Because again, yes, we have kind of low liquidity, but we have record options volume and record very short dated options volume, which should really command the attention or sort of drive price action, right? And I would just end on this sort of last point where we saw 0DT dry up was during the banking crisis, just like 2 weeks ago, right? We went from stable 45% of 0DT volume in the S&P, and that dropped to like 30s, right when suddenly the banking crisis was there and people started to buy tail risk protection, right? We saw a skew pick up. We saw all these signals that, hey, people were worried, and rightfully so, about the bank crisis, particularly when it was, sovereign bank going down. Remember that weekend, it was just a couple weeks ago now, but everyone was talking over the weekend, what's going to happen? We didn't have one of those environments in a long time where people were worried about, like no one was really bracing for Black Monday, but suddenly everyone was talking about positions over the weekend. And hey, normally I would hold a short straddle over the weekend. I'm just saying I don't actually do that every weekend, but you didn't want to go short vol into that weekend, right? Or you didn't want the theta decay guys, the theta gang or whatever probably backed off a lot. And at that same time, you saw that was record VIX call positions over that weekend, right? Record high VIX call open interest. There was people were positioned for owning Vega, right? And that dried up. That seemed to remove a lot of that zero DTE flow. So what I think is interesting about that is that I think what it does ultimately is creates this jump risk in the market, right? We're going to keep we keep these tight ranges, and then all of a sudden, you have these tight ranges and you depend on these relatively tight ranges, and then suddenly like something bad happens, and then it becomes like suddenly we flip from like zero DTE flipping to like a Vega trade where convexity, just kind of blows everything out. So there are these like there are these like binary states in the market now where it's sort of like there's no risk, let's all trade zero DTE, and then there's like, oh shit, something's gonna break, zero DTE backs away, and then the behavior of the market changes quite a bit.
I think that's a great point to end on. I'm sure you guys have been researching this and have been putting pieces out, but what happens the day comes when the market bottoms and these 0-day traders decide they don't have to actually sell a put, they could buy a put right there. What happens at that point. So it'll be fun. It'll be fun either way. But Brent, thank you so much for taking the time with us today. We're looking forward to showing you guys some stuff and continuing to working together with some metrics and things like that. So everybody go to spotgamma.com and we will talk to you soon, Brent. Thanks again.
Yeah, thanks for the opportunity. Appreciate everyone listening, Troy, and we're look forward to showing everyone some of the stuff we're collaborating on.
Sounds great, man. Have a good day.
Thanks, you too. See you.
See you. Bye.